Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers and it's going to be our morning edition. And here's the thing, you guys, I've been hearing so much reckless cheerleading. I really wanted to make a video this morning that really focused on empowerment, education, and basically the skills. And in other words, I want to pour into whoever's watching right now, at least, I want to pour into the knowledge that I have gained over the last 21 years as far as being a mortgage loan officer and a realtor and an instructor. So that's what I'm going to do today, you guys. And what I really want us to do is I want us to check our emotions, because obviously, like I warned you guys about, what is it, 2 months ago or 3 months ago, I warned that going into 2023, it was going to be an incredibly emotional year, especially if you're a well-qualified buyer. And you guys, do me a favor, let me know you can hear my audio okay. Let me know that it's not glitching. I'm kind of getting a little bit of a glitch here. So if you guys can comment down there, I would appreciate it. But here's the thing, you guys. I really hope, I hope you guys appreciate me once I finally get back into realty. The thing is, guys, is I am passing up, and I want you to know this, okay? I'm being transparent. I'm walking this out. I am passing up so much business, right? Okay, good. Yes, I can hear. Thank you, guys. Thank you. I love you guys. I appreciate all you guys so much. We got all our usual suspects here. I appreciate all you guys so much. But I really hope you guys appreciate me when I go back into realty, because what I'm doing right now is I'm sacrificing that income. I'm passing, I'm letting so much business go simply because of the fact that I don't believe in buying real estate right now. I believe buying real estate right now is an overwhelmingly risky idea for most people. So I've completely got out of that. And not only that, I hope you guys appreciate this. I've decided to, this is crazy. I've decided to walk this out with you, and I'm renting myself. And and it sucks. It sucks because I love real estate and I know how important it is to own real estate, but I also know how important it is to be wise with our investing. So I'm walking this out with you guys. And I hope you guys see that. I'm taking a massive hit on my income. And the reality is, and this is why I really want to empower you and talk about education today. I believe, and Jeff, I see you there. And I was talking to Jeff. I believe we're all going to take a hit. When the recession comes, when, things continue to start to collapse, I really don't think anyone's going to be safe. So in order to really be a winner through this thing, in my opinion, we have to prepare ourselves to take a hit. Right? And that's what this video is about. And that's what my channel is also about. When you're on the sidelines, if you're like me on the sidelines, empower yourself, educate yourself, and expect to take a hit like everyone else, right? I don't think anyone's going to escape this, y'all. There's just so many black swan events that are about, that I see about to happen. I see red flags at every single corner, and I still see emotion in the market. And honestly, and I know some metro areas haven't experienced, price crashing like that's happening in Austin, Boise, Phoenix, all over Northern California. That is hard. That's hard to witness, right? And again, usually everything's okay until it's not. Sometimes it feels like things happen overnight, the bank runs, for example. So anyways, I really want to try to, everyone to check our emotions today. And today's, again, I'm going to try to take the sensationalism out of my videos. You guys know I'm going to have a hard time with that. And when I say sensationalism, here's what I mean. Just embarrassing myself. So I'm going to try to not embarrass myself today. And we're really going to focus on education and power and value in that way. And I'm going to have everything chapters. Again, today we're going to go over interest rates. And again, we're going to take a look at the impact of interest rates, because the interest rates have gone down over the last 2 weeks. And then we're going to really dig into value, how to calculate value. The reason I really want to jump into value today is I dropped a couple videos the other day. I actually dropped a boots on the ground video yesterday. It didn't do that well for some reason. I thought y'all like my boots on the ground videos. But anyways, in that video, I showed multiple properties anywhere from a $60,000 to $130,000 price cut. So now what I want to do is, now that I have your attention, let's dig in and see, is that a good deal? And in order to determine whether or not something's a good deal, we have to go into the project, or we have to go into the new community with ammunition. We have to go into the communities, into the new home building locations with an idea of what homes we're selling for in 2022, so that we don't fall victim for the manipulation of the home builders, because a lot of the home builders are doing these price cuts to tempt you to buy. Do y'all see what I'm saying? And likewise, a lot of these new home builders are raising prices to mess with you. So I'm going to show you guys that today, and I'm actually going to make a separate video on how home builders are manipulating the market because it's crazy. And again, the problem is this: sometimes in order to really dig in as a consumer to these things, you have to have access to the multiple listing service, or MLS. Generally, in order to get access to MLS, and I love going, I mean, I stay up for hours sometimes looking at MLS. It's live data. You usually have to get your realtor license. So again, I know I'm preaching here, but I really think a lot of y'all should get your realtor license, because that's just going to help you. That's going to empower you. That's going to calm you down. And then if you want to talk about financial reward, you're going to save around 3% when you buy or sell a house, right? Plus you get to learn and you get to educate. And that's what we need right now. We need way more education, way less emotion. All right. So that's really what I'm going to try to do today, you guys. This is going to be a little bit hard, so just bear with me. And where we're going to start is, let's start at interest rates. Okay. So we're going to start at interest rates, and I'm going to probably go through interest rates pretty quickly here because I want to get to the value part. And guys, do me a favor, make sure that I'm timestamping this. For some reason, I always forget to timestamp. It's really, really frustrating. I got like so many things going on, I forget the timestamp. But anyways, let me show you guys the 10-year real quick. Here's the 10-year. So it's opening up this morning. You guys can see this isn't good. 3.2 is not really what we wanted to see. We wanted to see the 10-year higher. The reason I'm showing you all the 10-year right now is obviously the 10-year and the 30-year fixed rate mortgages follow each other. So the interest rates have gone down, right? The interest rates have gone down. And the question is how much have interest rates gone down? And what is that really doing to the payment? Is it just emotional buying right now? Or have the interest rates actually gone down enough to make a substantial difference, right? And let's go and pull up the interest rates right now. And you guys can see this, take a look, okay? So right now, according to Mortgage News Daily, interest rates as of yesterday, right? Is that 4 or 5? Yeah, as of yesterday are averaging 6.16%. Okay, so I'm going to use 6.16%, and really we're going to dive into basically start calculating payments. So I'm going to calculate payments on what interest rates were at when they peaked this month, what the payment is at when interest rates peak this month, what the payment is at right now, being that rates are about 60 basis points lower. And then I'm going to show you guys what would the payment be if we had interest rates like we did in the past at 2.75. Okay, so that's what I'm going to do now. In order to do that fairly, we have to see where we're at right now. Okay, so let's get our interest rate peak real quick. I'm going to show you guys how I'm going to do this. So here's where I'm going to get the peak. Let me throw this up here real quick. So I'm going to take the peak from right here. Okay, so March 9th, interest rates peaked at 6.73%. So that's the interest rate I'm going to compare to where we're at right now. And now obviously this hasn't updated yet. This is still showing 6.32. Let me refresh it because this will be updated today. Okay, it hasn't changed yet. Let me go back to the 5-year. Obviously interest rates have skyrocketed up, but again, that's how I'm going to do that, you guys. Again, I'm going to go back to the 1 year. I want to show you where I'm getting it. I'm taking a 6.73. That's going to be our comparison. All right. So first of all, y'all, I want to make sure I'm going to be testing you guys to make sure you're following along with me and paying attention, because it doesn't matter what I say if y'all aren't getting it. And that's really why I'm doing this. So I'm going to be testing you guys. So pay attention. Okay. Now, what we have to determine now is median sales price, right? We have to figure out what median sales price is so we can accurately compare this. Let me pull this up real quick. And I'm going to use Redfin's data, y'all. And I'm just going to take the $361,000, okay? Because that's as of March 26th, median sales price, $361,000 and on a national average, all right? So far, that makes sense to y'all. And again, the interest rate that I'm going to use is as of yesterday. So I'm going to use the 6.16%. From today's rates. And then I'm going to use the peak rate in March of 6.73. And then my median sales price I'm going to use, which is current, I'm going to use 361,000. Okay. Everyone follow along with me so far? Should be easy. And then I'm going to pull up this really cool thing here. I'm going to take out this info real quick. And this is what y'all could do as well. This is a mortgage calculator. Y'all, I'm trying to tell you how to do this. I've been doing this for 21 years. This is all you need to do. Now, obviously, you want to get with the loan officer. I'm not saying not to get with the loan officer, but y'all, if you want to see how much property costs, type in, look at in Google, you see up here, just type in Google mortgage calculator. This comes up, and I'm going to show you how to use it. All right. So pay attention. Okay. Now, obviously, I'm going to hit include taxes and insurance. All right. Now, we're going to take, what are we going to put in the home price right here? Everyone remember? This is like a weak test question. Y'all, everyone should get this question right. Tell me, comment below, what are we going to use for our median sales price? And also, I'm going to drink some tea because my throat is killing me. What do we use for the home price, y'all? What is the average home price as of the 27th? Do y'all know? Anyone know? No, Deuster. It's not a million. It's not a million, Deuster. It's 361,000. Church of Logic? Okay, Liam got it. Yes, my man. All right, I'm putting him up on the board. My man gets a gold star for Mike. What? Mike? What? What are you guys doing? What are you guys doing? Yes, my man. I'm keeping you up there. It's 361. Thank you, y'all. Y'all already hurt my feelings. This is for you guys. Look at, I'm putting 361,000 as our home price. Okay, we're just gonna put a 5% down payment. And again, you guys could do this yourself. You guys could do this yourself. Y'all feel me? Y'all could do this. Another million. What are you guys doing? You guys are funny. I need to stay focused, okay? But look at, we're gonna put 361,000 right here. We're gonna put a 5%. Let me get this out of here. We're gonna put a 5% down payment. Now, again, you guys could play with this yourself. And here's where you put property taxes right here. Here's where you put homeowners insurance, right? Private mortgage insurance is automatically calculated. Your homeowners association monthly dues are not included in your payment. So really these first three are included. It's automatically calculated, but you guys will always want to come back and readjust your property taxes. I just want to make that a point. You can also select your credit score. This is going to impact an automatic rate up here, and it's going to impact your private mortgage insurance, okay? So I just put good credit. I'll put 740, but we're looking at interest. Okay, so again, here's my setup: 361,000 median sales price, 5% down. Now let's start playing with the interest rates. All right, so first let's put in 6.73 because that's what it peaked at in this month. All right, so we're going to say 6.73. You guys can see the payments right here. Okay, so we've set up our template. Now we're just going to play with interest rate. Y'all follow? Everything is set up now. We're just going to play with interest rate. Obviously, I could put 20% down payment. I could put 10% down payment. I could change all this stuff, but we just want to see the interest rate changes. That's what we're saying here. And we're doing it on an average, right? 361,000 sales price, 5% down. And we're starting at the high interest rate. So when interest rates peaked, okay, and again, this is going to be rough. We're just doing an average, a basic average, but I want you guys to know this month, mortgage payments peaked, as did interest rates, at $2,220. Everyone with me? Okay. So when interest rates were at the highest average, weekly average this month, mortgage payments averaged, again, it's not fair because this is like ideal credit. Most people don't have ideal credit, but we're just doing info based on what we have. $2,220. Now, let's take this all the way down to what rates are today at 6.16, which is a pretty steep drop. Now look at, everyone is freaking out. Now, we don't want interest rates to be low, keep in mind, but there's an overwhelming amount of people that are freaking out. Everyone's flooding back into the market based on a lowered payment of $2,092, okay? That represents, y'all, only $128 difference a month, okay? So again, $128 difference a month. $128 difference a month, which is a decent amount, right? And everyone's freaking out. But what people are not realizing is that's actually not accurate, because what is way more expensive this year, y'all? Comment below. Comment below. What is way more expensive this year that has to do with your home and has to do with your mortgage payment? Comment below. I want to see if anyone gets it. All right. What's way more that's not reflected on just the interest rate change? And when it comes to renting, y'all, if we are on the sidelines right now renting and we're waiting for interest rates to lower when the Fed pivots, if we get a 5% versus a 6.5%, we save tens of thousands of dollars on just interest. So all of this, oh, just buy now, renting is a waste of money. Yes, renting can be a waste of money. But if we play our cards right, we're going to do fine. We're going to do okay. But if we get lazy, okay, there we go. There we go. Look at, okay, here we go. Yes, sir. My man. Okay, you got it first. Insurance. Also, property tax. Thank you guys so much. I just really want to make sure you guys are following along with me. I appreciate it. I really want to empower you, or else why am I here? Okay. So insurance is through the roof. I just renewed the insurance on the rental property that I have. It went from $1,800 to $3,500. My property tax on the second property that I still own it, but I have a note on it. It will be paid this year. My property tax went up, assessed value $80,000, and I have a 3.5% tax rate on that house. So what I'm saying is even though if we just compare interest rate to interest rate, it is dropping, right? It did drop, what do we say, $128. There are so many other things that are so expensive that $128 is really nothing. But let me show you this. Okay, let me show you something else. You guys following me? Okay, you guys following me? Okay. I'd rather spend in rent than lose massive amounts of equity. Exactly. Okay, now let me show you this. Okay, let's take in the super low interest rates into account. So we're going to use 2.75. Okay, so right now we're going to compare the 6.1 that everyone's happy about, and they should be. They should be. I mean, that's a little bit lower. That's a little bit lower. And we're going to go at 2.75, which is around the low when the interest rates were low, during the pandemic. So I just wanted to point out that in the past, at a $361,000 loan amount, when the interest rates were 2.75%, that made the mortgage payment, again, we're just talking about principal and interest. We're not talking about the total mortgage payment, which includes taxes and insurance. We're only talking about PI, or principal and interest. So in the past, that same house at $361,000, it only cost us $1,400. Do y'all see the systematic failure? The systematic failure is not the high interest rates. The systematic failure is the $1,400 payment on borrowing $361,000. That's what wrecked us. So anyways, the difference of $1,400, which was where we're at during COVID, to where we're at right now is $700, or rather $692. So even though we made a little bit of progress, we got back $128, we still have a difference of almost $700. And the normal person, including myself, $700 more a month. It's a game breaker. Okay. Do y'all see what I'm saying? So in other words, what I'm really trying to hit home here, guys, is what we're seeing right now is emotional purchasing. We're still seeing emotional purchasing, emotional toxic cheerleading and reckless cheerleading and throwing up the cheerleading. And it's still not purchasing based on affordability, income, wage fundamentals, right? It's still so emotional. And here's another reason why buyers could have come back. And I was listening to Economic Ninja. I listen to all these people to try to get different perspective, but he's like, man, there are a whole bunch of buyers came back because tax returns. I was like, okay, yeah, that's possible. Like, I would want to know what the dollar amount is for the tax returns, but it is possible that influx came from, the money being pumped in as far as tax returns. But for me, I think that's a possibility. But what I really think is like people lost their nerve. People lost their nerve because you guys understand how strong emotions are. Let's not act like emotions aren't strong, right? Fear of missing out, bidding wars, appraisal gap. That's a result of emotion, not logic and not strategy. Okay, I just want to make that clear. So, anyways, do y'all see what I'm saying? It's important to understand that the difference of payment is about $130. That's it. Is that grounds to get excited? Guess what hasn't started this year? Comment below. Let me know that you guys know what payments still have not started this year. What are we waiting for? I know Vital. I know now. And here, let me pull up Vital real quick. I love you, Vital. I want to make this clear real quick, y'all. And I'm not talking trash on anyone. I don't care if someone's been talking about a crash for 3 years. Hopefully they saved a whole bunch of people. I really want to make you guys understand this. I've been talking about the housing market crash for a little less than 1 year and 1 month. I started talking about the housing market crash in March of 2022, 3 months prior to hitting the peak and crashing. Just FYI, because I see a lot of these reckless cheerleaders. Oh, the crash bros, where's the crash they've been promising you on the west coast of the US? Like, the thing is, it has to start. It has to start. To discredit the price crashing in some metro areas is reckless because why? It's a red flag. It's a sign. It's incoming, right? Florida, y'all. Let's just keep watching Florida. I am so interested in Florida. I'm sorry, I went off on a tangent. I want to throw this back up here, y'all. I love you guys so much. Yes, student loans. Student loans. Yes. Student loans are about to happen. I'm just saying, student loans are about to happen, y'all. That's pretty crazy. But I want to go back to this payment calculator before we really dig into value, because I'm going to blow y'all's mind. It's not going to be entertaining. It's going to be hopefully like mind blowing, right? That's what I want to show you as far as the value. But look, going back to here, here's how you do this. Again, I've been a mortgage loan officer for 21 years. Okay, this is what I'm saying. First of all, if you're actually out there really trying to like actively purchase, you're going to need to get with your loan officer. So I'm not saying use this information to segue your loan officer. I'm saying use this information on the fly. Like this, I always use this program on the fly if I want to come up with a quick payment. Now, here's what's interesting. You're always going to have to adjust the property taxes. Property taxes vary significantly when it comes to mortgage payment and property, okay? Especially where in Texas, where I live, property taxes can be 4.1% to 2%, right? So it could be, look at my payment. So at $4,500 taxes, my total payment $2,100. But if I'm in Texas, my taxes may be $10,000. Okay, brutal, right? So it goes from, you see how much that goes up? So now it's $2,561. So when I'm out shopping, one of the strategies when we have more inventory, especially, but one of the strategies to use that I'm using when I'm looking for property is low property taxes. See, that's a difference of $400 a month. $400 a month that basically being thrown away in property taxes. In other words, your property taxes are vital. And when it comes to new construction, generally your property taxes are higher when purchasing new construction. So I want y'all to know that. Now, here's another strategy I use when purchasing. Now, my method of purchasing my primary residence is putting 10% down and paying the PMI up front. Personally, and I'm not a CPA, get with a CPA, okay? When I pay PMI up front, that's a tax deduction. So I throw that on my taxes, I get a nice tax deduction, but it also decreases my payment without having to refinance, all right? So, and also it gives me a better ability to cash flow if I need to move. Y'all see what I'm saying? So even if you're not purchasing an investment property, you should treat your primary residence, as an investment property because it's just really smart to do that. All right, but anyways, so let me show you the impact of, so look at, let's put 10% down, okay? 10% down, my payment's around $2,000. Y'all see that? But when I go down here, do you see my monthly PMI right here? Adds $149. If I pay that up front, say that will cost like $4,000, I have the option to get rid of my PMI. So I'll pay that up front, I get my tax deduction, and my payment goes down to, see this? $1,848. So that's much easier to cash flow. And again, this is just my personal strategy. A lot of people will put 20% down. I understand the whole argument with 20% down, avoiding PMI. I get all of that. But personally, I don't want to spend all of my liquidity because I want cash is king, quite frankly. So I'm going to take advantage of financing. I'm okay with that. And I'm okay with 10% down paying PMI. So that's just a little bit of a strategy that I use as far as when I'm looking at my primary residence. That's how I'm using the mortgage payment calculator. But I also want to just really, enlighten you guys. $128 a month is not grounds for people to freak out to the level of that people are freaking out. It's some good progress as far as reducing payment, but is it grounds for like everyone to start like losing control again of their emotions? I don't think so. I really don't think so. Again, I think we're all going to take a hit. I think I'm going to take a hit. I am preparing, and I really hope you guys are understanding what I'm saying here. And I hope you've been following along with me. I've been trying to prepare y'all the entire time on the sidelines. Credit, income, assets, being an expert in your local housing market, mindset. One of the primary reasons I'm trying to prepare you guys, obviously, to become a winner. I want everyone to become a winner just like me. I want to become a winner, but I believe we have to get through the hit first. So the stronger we are right now, credit, income, assets, the more we can get through the initial hit, because everyone's going to get hurt, in my opinion. Most everyone's going to get hurt through all this. I hope I'm not rambling, you guys, but I think I'm going to get hit too. I think I'm going to lose my job. I don't want to lose my job, but I'm preparing to lose my job. I'm just being honest with you. My job, I'm in W-2 employee, and I'm not in sales, and I'm in the mortgage industry. I'm preparing for that. Now, because I've been preparing for that, if I lose my job, I'm going to be okay, right? I have savings. I'm out of debt. I have other sources of income. Do y'all see what I'm saying? Prepare for the worst. Hope for the best. Prepare for the worst. And I really, please, guys, I hope you're learning here. You don't have to agree with what I'm saying, but at least get these little bits of tools. Now, this is what I'm going to do next. This is going to be hard, and I want to make sure you guys are paying attention. We're going to go into value, and I want to tell you guys this before I go into value. I teach classes on appraisals, on how realtors can fight appraisal value and how appraisers come up with value. I teach a class certified through Texas on how appraisals work. All right. So I understand value. The things with my videos is I can't put all of my 21 years of experience in just one video. So that's why I'm really loving these lives. So my lives are going to be, I really want my lives to be about education, and I want it to be about value, and I want to give you guys all of that stuff. Now, here's what I'm going to do. Okay. I'm going to pull up my MLS. We're going to go through my MLS and we're going to take a look at some stuff. All right. Here's the thing. Here's why we're going to take a look at some stuff. The video that I did yesterday, I have to change this real quick. Let me stop my screen share. Present. I have to do a different screen share, y'all. Just bear with me 1 minute. I got to do my entire screen. It's going to throw this up, and then I got to go back down like this. But anyways, I'm going to pull up one of the primary. Let me switch back right here. I'm going to pull up one of the primary reasons, like I said, that I am showing you guys the value. And really the reason is because the video I did yesterday, I want to show you that how to know if it's a good deal. So like when you go into a new build community, like this is what you need to have in order to determine if it's a great deal. Because remember, they're playing tricks on us. Like these massive price cuts are to lure us in. And then these price increases are to like act like, oh, everything's turning around. When the reality is both those scenarios are manipulating people. So I'm going to show you guys that today. I'm sorry for rambling. I just wanted to pull this up. Okay, good. I got it working. And I have to change that here in a minute. And the reason is StreamYard is like super laggy. So I have to do a couple things differently. I'm going to pull this up. Okay. All right. Here we go. So take a look at this. Here's why I'm going to show you guys value. Here's why I'm going to show you, the tools that you need to bring in to new build communities. Because remember, I did 2 videos and I showed this to y'all. Y'all see this? This is what $130,000 price deduction. Okay, you see this? This is a $130,000 price deduction. But the thing is it a trick? Is this just a trick, or is that a true, deduction under market value? Same with this one. Look at $81,000. Is this a trick, or is this real value? Is that a real cut? Same here. Is this a trick, or is it real value? Do you see what I'm saying? You guys see what I'm getting at? Look at this, $70,000 off. Is this a trick, or is that real value? Now I want to point out, okay, real estate is hyper local, and I'm going to start getting into this more and more. It's hyper local. Now, in order to determine if these are good deals, we don't do a market analysis on the city. You guys should be doing your market analysis. If you're a realtor watching, watch this segment of the video, because I'm going to show you from scratch how to review communities. So we don't have to, oh, it's a great deal, it's a big price cut, which is all sensational. Look at the data, take out the emotions, right? Y'all see what I'm trying? Anyways, so what I'm going to do, let's pull up. Oh my gosh, I didn't do the timestamp, y'all. I didn't do the timestamp. Y'all were supposed to help me. Okay, here's what I'm going to do. I'm going to remove this, and I'm going to stop sharing. I'm going to present my screen one more time. Sorry, guys, I have to do this. So it's a glitch thing with StreamYard, but it's okay. StreamYard's really, really good. Okay, I got it set up. Now, you realtors are going to love this. Okay, I'm going to pull this up, and I'm going to be testing you. What the heck? This is not what I want. Okay, hold on one second, y'all. Now, remember, I'm going to be testing you as well to make sure you're following along with me, so that I make sure, and I want to make sure I'm not going too fast, okay? So I will be testing you, so I want to make sure that you guys are following on. Boom, okay. Now, what I have here is what y'all need. What I'm saying is anyone that wants to buy, in my opinion, and I'm a little bit pushy, I understand. This is what you guys need that you're looking at right here. If y'all want to stop listening to the toxic cheerleading, the reckless enthusiasm, all of these realtors throwing up complete nonsense and all of these hate and nonsense, this is what you need. This is why I'm so confident, because I see what's going on behind the scenes. This is the behind the scenes. This is the matrix, right? Or better said, multiple listing service. What am I talking about? Multiple listing service. Right here. This is all live data. And a good realtor, even a decent realtor, can edit this and filter this in so many different ways to pinpoint exact value. Okay? So this is what we need to do first. Now, all 4 properties that I just showed you with those price cuts were in a subdivision called the Highlands. That was the name of the community. Now, do you see in the matrix, do you see in multiple listing service, there's a subdivision section? Because why are we doing this, y'all? Why are we doing this? Why am I looking at subdivision? Because real estate is hyper local. Y'all tracking with me? Real estate is hyper local, right? It's not about Austin if I'm living in Houston. And it's not about Houston if I'm looking in a subdivision in the Highlands. You see? Y'all see? We got to go hyper local. This is what you have your realtor do. You sit with them. You have them come to your house. You have them pull this up. This is what you have them show you. If you're a realtor, this is how you help people. So all of the comps, the video I did just yesterday, the boots on the ground, was in the subdivision of the Highlands. Okay? See? Now I have the Highlands in here now. Now what I'm going to do, it's like really case sensitive. I put 2 periods. Okay. So now I have this on active listings. I can see there's 59 active listings, but I want to look at sold property. Remember? Why do I want to look at sold property? Because sold property is what's considered a comp. The way that appraisers, lenders, people determine value for houses is by sold property. Listen, it's by sold property. Properties that have sold, that's called a comp. Comps are needed for appraisals. It's not based by price per square foot anymore. Once we get real, it's based on comps, similar properties with similar characteristics. Do y'all follow? Y'all track? Now, what we have to do is we have to figure out what the average price per square foot was in 2022 so that we can determine whether or not those price cuts are real. Okay, so what I'm going to do is under the sold right here, I'm going to put the entire range of 2022 by putting January 1st, 2022. Jeff, Vital, Johnny, if you guys don't get your license and do this, I'm going to be so disappointed. Any of my core viewers, this is what you guys need to do. If this is what you do, I'm going to be so proud of y'all. I'll start crying in the closet. You know, in the closet, I say, because I don't want anyone to see me, but I'd be so proud of y'all. This is what you need. All right. Anyone asking what's going on in my local market, this is what y'all need. This is why the dependence on the realtors. Now, I'm going to put to December 31st of 2022. Okay. That gives me 137 sold properties in the Highlands. Okay. Let's hit results. Now, I have my 137 sold properties in the Highland. Each one of these is a comp from 2022. Do y'all follow? Now remember, I'm going to select every comp here. I'm going to go down to stats right here. I hope you guys enjoy this. You're welcome for the free training if you're a realtor. I'm going to hit stats right here. You guys see the behind the screen, behind the scenes I'm doing? And then I'm going to hit tabular. Look at this. This is what we know. We don't have to guess, okay? What do we know? What do we know, you guys? We know. See, without this piece of information, we're flying blind. You guys hear me? Without this piece of information, we're flying blind. Right now, we know, okay? The heck. We know the average home in the Highlands in 2022, I know that was last year, sold for $183 a square foot. Again, without this information, we are blind. Without this information, we can be manipulated pretty easily. We must know what homes we're selling for in the past to understand whether or not these price cuts are a big deal. Y'all tracking with me? Tell me, yes, you understand what I'm saying. Please, you guys, tell me you understand what I'm saying. In order to understand if current price cuts are real price cuts, we first have to understand what properties we're selling for in the past. Please comment, yes, I understand. Or if I'm going too fast, let me know that you guys are tracking with me so far. Okay? Let me know that you guys are tracking with me, please, so far. If you guys can, just say, yes, thank you, I am, thank you. I really want to make sure you guys are, with me on this. Now I'm going to go back. Good, okay. So now that we know what? We know the average home sold for $183 in 2022, correct? Thank you guys. Thank you for humoring me. Thank you for saying yes. I'm glad you guys are with me. Now that we're empowered, we are empowered now with the bare minimum of price per square foot. Now I'm going to go into the community. So now they can't fool us. Now they can't trick us. Now we can't be sold because now we know and we're empowered. You follow? Now I'm going to active. What am I going to put in the subdivision, y'all? What am I going to put in the subdivision? Because remember, what am I showing you? Hyper local strategies to determine value. See, hyper local. What do we put? Right? We put the Highlands in the subdivision. When an appraisal is done, at least in Texas, the comps for the appraisal to determine value are used from subject property subdivision. There are rare events where people go out of subdivision, but almost every single time the comps must be in the subdivision, which is why we're putting the Highlands here in the subdivision. I'm going to active. Let's hit results. Okay. Now I'm going to categorize by what? What do I categorize now? Price per square foot. Now look at this. Okay. The most affordable house, price per square foot in the Highlands, had a price increase. Do y'all see what I'm saying? Do y'all see what I'm saying? Let me zoom in here. Hope you understand what I'm showing you. They're tricking us. The home builders are tricking us. Again, what do we know? 2022 price per square foot average $185. We know the cheapest home in that subdivision price per square foot wise, and we'll do more research, but price per square foot wise is $161, meaning that that property is listed over 10% lower than what homes were selling for in 2022. Do you follow? Do y'all follow? Now, isn't that astonishing that the most affordable house has a price increase? Isn't that interesting to y'all? So, most affordable house, price increase. Look at we don't in all these other ones, these are all the top most affordable. Look, 2 more of the top most affordable houses have price increases. Isn't that interesting? Isn't that interesting? But I want to show you guys price cuts now. All right. Let me go to page 2. We're going to look at some price cuts. And I'm going to show y'all some tings. I'm going to show you some tings. I'm looking for that price cut, that really big one. Where is the big one? I don't know where the big one went. Okay, let's go here. I'm going to show you some price cuts, and I want you guys to say yes or no, this is a good deal. Okay? Now, I'm going to change I can't change my picture. Dang it. All right, first price cut. Look at this. Look at this. This is a price cut of $50,000. This should be the best priced house in the entire park, right? This is a price cut of $50,000. Price per square foot, $197. I want you to comment below. Is this a good deal or not? Is that a real price cut or not, y'all? I want you to comment below. This price cut's bringing this property down to $197 a square foot based on only what I'm telling you. I know we can go even more hyper local. We can talk about the builder, but just for the sake of argument, tell me that's right. Why is that not a good deal? You guys are right. That is not a good deal. That price cut is fake. Why is that fake? Why is this price cut fake? Why is that price cut fake, y'all? I want you to comment below. Everyone gets it. Everyone's saying no, that's correct. This is a fake price cut to get you to feel good about purchasing this house. That's correct. You got it? Very good. Appreciate you guys participating. That's right. The price per square foot is still too high and significantly by about 7% higher than 2022 averages. This is fake. This is to entice you. Do y'all see what I'm saying? This is a sensationalism. Let's go to the next one. Okay, look at this. Decent price cut. This is a $17,000 price cut. New price per square foot, $198. Is that a good deal, y'all? No, that's not, because it's over, right? Let's look at this one. Same thing here. Do y'all see how easy this becomes once we're empowered? Do y'all see how easy this can become? We don't have to look at price cuts and sales and realtors and all this hoorah crap when we can use the data, because the data will speak for itself, but we need to access it. And again, if you guys can't do what I'm showing you, this is what your realtor does for you. This is a bad price cut right here. Let's keep going. I'm just going to go quickly. Look, another price cut, $199 a square foot. Next one, no price cut, 200 square foot. Let's keep going. $200 a square foot, $40,000 price cut. $40,000 price cut, $200 a square foot. The joke's on us. The joke's on us. You see this? $200 a square foot. Look at that. This is crazy. I wanted to see the price cut though, y'all, of that really big one. Let me show you this now. I'm going to go back here. Okay, so we're starting to learn now, right? We're starting to learn. So the ones with the math, listen to how crazy this is. Let me keep going back. Let's recap how crazy this is, okay? So we know $185 a square foot is the average. So we could determine the, let's see, 12 properties. So the top 12 properties are selling for under 2022 values, but only 2 of those properties have price declines and 3 of them have price increases. So they're messing with our brains. Unless we have this data, we don't know. We don't know. They could easily trick us. Y'all see what I'm saying? So the best house has a price increase. This is just insane. And then look at this. The homes with like magnificent price cuts are the most unaffordable. They're the most unaffordable. All right. So I'm going to pull up even more local. So in subdivisions are subdivisions. Okay. So I noticed one of the houses that I showed y'all yesterday with the $130,000 price cut was in actually a subdivision called the Highlands. Because remember, this is hyper local. Highlands 65. Okay. Now, again, they took it off the market. Look at that's crazy. They took it off the market. So that $130,000 price cut, it's not even on the market anymore. Probably the cat's out of the bag that it wasn't a real price cut. But look at, I'm going the Highlands 65. Okay, that's where that really big house was. That was price cut, and it was price cut. That really big house was price cut down to $197 a square foot. Okay, so the big house in where? What subdivision? See how I'm going even more hyper local? The Highlands 65. So when I first look here, I'm like, oh, dang. I was like, okay, maybe that's a real price cut. Because remember, the $130,000 price cut took the price per square foot down to $197. Again, it took it down to $197. So when I first look at this, I'm like, yeah, that was a real price cut, right, y'all? Was that a real price cut, y'all? Look at this. It's always important to understand the bigger the house, the lower the price per square foot. So it's really not necessarily a good idea to be comparing smaller houses, 3,000 square foot, 3,000 square foot, 3,000 square foot, to a 3,800 square foot home. So when I'm looking at this, what I'm immediately thinking is I'm like, whoa, whoever this person was, whoever their realtor was, got a pretty solid deal at $168 a square foot. Now remember, this similar house, okay, so this is 3,700 square feet. The house I showed you with $130,000 price cut, you know, it $197 a square foot. So this represents a what, 10, 15% reduction. I'm telling y'all, whoever did this, good realtor, because the builder wanted them to pay these prices, $218, $215 a square foot. But this realtor right here got it down for $168.52. How do you think they did that, y'all? Let me show you how. How do you think they did that? How do you think, why were they so good? I'm going to go back to sold properties. Let's go over 360 days. I'm going to show you how they did that. Okay, I'm going to hit off active. Now remember, I'm going back to the subdivision, hyperlocal, the Highlands 65. Now I have 6 homes that sold. Look at this. Another comparable. Look at this comparable. This is how that realtor did that. See? $170. So this home sold about 7 months ago for $170 a square foot. Look at the size of the house. See that? So what I'm saying is whoever bought this house, more than likely their realtor saw this comp right here and said, my client is not paying over $635,000 to my house. Do y'all understand what I'm saying? Does all that make sense to y'all? Let me show you something else, okay? I'm going to go back here. Let me show you this. I'm going to go to the map now, and I'm going to do another segment on new home builders and how they're like manipulating us in a different video. But let me show you this. Man, I love the matrix. I love having access to this. Okay, again, I'm going to make a video on this, so I don't want to cover too much of it right now. Okay. Oh, you know what's going on here? I have to change my criteria. I have to remove the Highlands because I want to show you this other community and what these builders did. Okay, so this is a building. This is a new build community right here. Okay, so like there's a cluster right here of new builds, and there's a cluster right here in new builds. Now, you guys probably don't remember, but I've been talking trash on this builder for about 7 months, basically saying they're way overpriced and they're missing the boat, okay? They have recently, again, this new home builder has recently price cut all of these houses about 10 to 15%. They have. But what's interesting is this. Take a look. I'm going to click on this listing, all right? Make sure that this is the new build right here. Yeah, Liberty Homes. Okay, so I'm going to let me show you guys. You guys are going to freak out. Now look at this. The common person is going to think this is a brand new listing. This builder has reset all of their listings. And the reason they reset all of their listings is because they started looking like absolute fools. They were doing price decreases and price increases and then decreases and then all over the place. And then finally they said reset. But because I'm a realtor and I have access to MLS, I get to see all of the history of this listing. So right now it's not showing any price cuts. It's showing 2 days on the market. Take a look at this. When I go to property archive, let's look at the history of this house. First of all, what I want to say is they could say that they raised prices. Look at, they listed this house for less. Y'all, they listed this house for, and they raised the price on the house. They can't even sell it. This house was listed March 13th for $424,000. Okay. March 13th, it was listed for $424,000. And look at December. This is crazy. December, this property was listed for $419 and they couldn't sell it. So now this builder says, oh, what? Guess what? Sorry, guys, we're raising our prices, right? Is that correct? Because I hear all the comments in my description, oh, they're raising prices again. They're raising prices again. Is that correct? According to this data, they also raised the price. Is that right? Okay. They raised the price from $419 back in December to $429. So these people, yeah, they raised the price, but let's look at the past. Let's look at the past. Look at this. This house has been listed since, look at this, 2021. So let me ask y'all, did they really raise the price? Or are they going in circles chasing their tail, hoping to spider web someone? It's a spider web. They want to catch a fly. They want someone to get stuck. This house has been listed since 2021 for $421. In fact, when it was listed in December, look at this. When it was listed in December, all right, of 2021, a year and a half ago, it was listed for more than what it is right now. So this house was listed for $433 in December. It's now listed at $429. So I asked you, did they increase prices? Did they increase prices? Because what I see as a realtor when I dig in, I see them listing this house for under what they listed it for in 2021, at least at the end of 2021. Do y'all see what I'm saying? So to me, when I go into this property, they're going to be like, no, we got demand back, right? We got demand back. We're raising our prices. But the reality is they can't sell this house and have been trying for the last year and a half. Do y'all see? And look at this. This is crazy. They lowered this to historical lows. They lowered this house to historical lows, $419,000. They have never listed this house for $419, going back all the way to 2021. Look at, they have never listed this house for that low, and they still couldn't sell it. They still couldn't sell it. And here's the crazy thing. If they would have listed this house for $429, which is what it's listed for now, if they would have listed this house when it peaked, when the market peaked right here, they would have sold that house. The reason they didn't sell that house in the peak, their houses were listed too high. Do you see what I'm saying? They keep shooting themselves in the foot, trying to make as much money as possible, when the reality is all they're doing is spinning in circles and making it more expensive. And they're adding to the fear of missing out and the entire narrative that, oh, new home building is going up now. Do y'all see what I'm saying? Comment below. Let me know that you see what I'm saying. This is why we need data. We need to see. They weren't telling me that this house was listed when it was okay, actually the original listing date was right here. I mean, this is insane. They've been trying to sell this since July of They've been trying to sell this since July of 2021. Look at, they had it listed all the way for $471, you guys. These people are crazy. Look at, and they keep shooting themselves in the foot. They could have sold right here. This was the peak. This was the peak. Instead, what they're doing is oh, we messed up. Terminate the lease. So people can't see how desperate, and we're going to put a new listing. Look at, and then they put a new listing together just like they just did. And they put, oh, price decrease, price decrease, price decrease. And then they're like, nah, we're going to mess with people's emotions. We're going to do a price increase. And you know what? We're not only going to do a price increase, we're going to do a second price increase, because we want people to know that prices are going up. Even though we can't sell this house and we've been trying for 2 years, prices are going up because look it, we have a price increase. Do y'all understand? Do y'all understand? Sorry, y'all. That was a little bit long-winded. I really hope that that made sense. So in other words, here's what I'm saying. we got to take the emotion out of purchasing a house. We need to do the best that in my opinion, we need to do the best that we can to use the data to help us figure out the trajectory of things. We need the data to help us figure out what a great deal is. What do we know? We know new home builders are trying to trick us. What do we know about realtors? Most realtors are toxic and reckless cheerleaders that have absolutely no social redeeming value to society. And I see big YouTube channels that are dying now, and they refuse to understand what's happening. Again, I told you guys at the beginning of this, they're like, "Oh, Crash Bros, where's the crash you've been promising?" And I'm just thinking to myself, Austin, Phoenix, like, where's the crash at? Open your eyes, maniac. You know what I mean? Like, open your eyes instead of being derogatory and refusing to acknowledge the systematic failures, to refusing to acknowledge the cracks in the system. We already see what's happening on the West Coast. The East Coast has rebounded slightly, but how long is that going to last? Seriously, guys, think about it. How long is it going to last? I mean, we're already seeing it fall up. We saw it fall apart in China. We saw in Australia new construction fall apart. We know new construction developers right now are tangled up in luxury apartment complexes, which luxury apartments has a higher vacancy rate, and that's actually going up. So, in other words, y'all, so far what we talked about is interest rates. I hope that we kind of took the emotion out of interest rates. We looked at the reality to how that affects your payment. And then we went into how to determine value. Okay. And this is my promise to y'all. From this point forward, when I do my boots on the ground metro video reports, which I love doing those, and you guys know I was going to go to Austin and San Antonio. The reason I didn't, it's raining like crazy. I was so ready to go, you guys. I was all ready to go. And then I looked at the weather. I'm like, nope, I'm not going. But the thing is when we understand how to use the data and how to read the data, then we don't need to rely on toxic cheerleaders, you know? And this is my point. What I just showed you guys right here, that's my point in finding a great realtor. Great realtors will do this without you asking. Raise your hand if a great realtor has done that for you. Probably no one. See my point? And that's why I get so mean at sometimes to realtors, is because I've been doing this for so long. I've trained probably thousands of realtors. So when I see these comments, it's just so like, it's just kick rocks. Like, I don't even want to explain it anymore. It's just like, I don't want to waste my time with realtors, because I know you can't educate someone if they're pretending to be stupid. They're pretending to be stupid. They know what's happening. They're pretending. You can't help people that are pretending. I'm just saying, why are they pretending, y'all? Why are realtors pretending? You know, in my opinion. Comment below. Let me know why you guys think that realtors are still cheerleading. And I'm talking about they're cheerleading still. Phoenix, Las Vegas, places where it's crashing, in Austin. It's never been a better time to buy. You can refinance later. Don't get trapped renting. You know, all things that make sense when we have a balanced market. Actually, even that doesn't make sense, okay? Why are they cheerleaders? So we got one that says because they're lazy. That's pretty much true, but here it is. This is it. Pretty simple to understand, guys. It's pretty simple to understand. I mean, are we really supplies? What does it say in their license? What does it say? It doesn't say realtor. What does it say? It says salesperson. They got to stay working. So I don't want to be, the only reason, and normally I wouldn't be upset at someone's livelihood, right? I want people to do well. I want people to make money. The reason I get upset about this specifically is because when they're wrong, and we've already know that they're wrong in certain metro areas, they're leading people to financial suicide. Or if not that, stress and anxiety, buyer's remorse, and things like that. And because I personally went through foreclosure, bankruptcy, and repo, and I understand how emotional that is and how scary and the depression that comes with that, I get upset. I get upset at them because I know what they're doing. They're trying to get you to call them so that they can make money. We get this. We get that. We understand this, right? I mean, so if you're a realtor, you guys, and if you're a realtor watching this, I just want you to understand that I'm just talking in whole. I know there's great realtors, and I want to help. Even if you're a new realtor, you're watching me, make no mistake. I'm not trying to hurt your feelings. I'm trying to warn you especially if you're new, how the real estate market works. What my mom taught me is all you need, y'all, truth, transparency. That's it. Because no one has it in real estate. That's all you need. So if you're a new realtor, play around with MLS, multiple listing services, do market analysis, give that to your clients. Stop, please, you guys. Stop the cheerleading. There's a time for it. And now's not the time. Now's not the time. These cheerleaders are the doom and gloomers. These cheerleaders are just trying to freak people out. They're the people now, fear, uncertainty, and doubt. What are the realtors' fear, uncertainty, and doubt? How are they doom and gloomers? Comment below. How are the realtors now the doom and gloomers? How are realtors now fear, uncertainty, and doubt spreaders? How? How are they now, y'all? Because it's crashing. Okay? They're trying to make you afraid. They're trying to give you fear. They're trying to make you buy right now. They're trying to tell you if you don't buy right now, you'll never be able to buy, even though we see the market crumbling. Not in every metro, but that's how it happens. You can't snap your fingers, right? You can't snap your fingers. Oh my God, I'm rambling. I'm so sorry. What's up, my man, Luke? So sorry about that. I realize that I'm rambling. So we're going to go on and we're going to talk about credit now, y'all. Let me make a timestamp real quick. So I want to talk about credit. I'm going to read a brief article and then I'm going to take your questions. So this is really going to be a question and answer part. I'm going to give you all the tips on credit. Again, this is very important if you want to understand. Luke's at the beach. What's up, Luke at the beach? This is very important to understand, y'all. If you want to understand how credit works exactly, why is my focus all messed up? If you want to understand how it works exactly, let me pull this up, okay? All right, now, first what I'm going to do is I'm going to briefly go through this article, just so you guys know that what I'm saying is accurate. Okay, and I did post this in the description. Now, again, credit, very important. Anyone on the sidelines, even if you're not on the sidelines, you got to get bomb credit. My credit's pretty good, right? My credit's real good. And I had a bankruptcy foreclosure repo. Yeah, I did. And my credit's bomb now. It took me so long. Anyways, 5 factors that affect your credit score. Now, what do I always say is king? What am I always telling you guys before I really go into this? Now, I want you to comment below. What am I always telling you as far as your credit? What do you want to focus on? Comment below. I want to know that you guys remember, what do you need to focus on if you want higher credit? Now, look at this. This is very interesting. It's saying that 799 credit score is very good and not exceptional. I'm just gonna be honest, like 799 is exceptional. So I'm in the very good tier. And it's also important to understand that different industries have a different algorithm and have a different FICO score. Like your credit score, your credit score is going to be different when you go shopping for a car versus when you go shopping for a house, right? So let me see here. Jeff, what's up, Jeff? Is Matt the mortgage guy here? Where's Matt the mortgage guy? What's up, Matt the mortgage guy? Yeah, I always like to have my peer. I like my peers, even though my peers and we don't always agree. I like my peers, man. You know, I'll go on live and not argue with people, but just ask like cool stuff. So Matt, the mortgage guy, agreed that some realtors, mortgage advisors put profits before people. That's all I'm saying, Matt. You know, people make fun of me, even your crew, Matt, even your crew. And I appreciate you commenting, Matt. I do, brother. I really appreciate that. He has a channel. You guys go watch it out. And I know your crew slams me, Matt. Your crew slams me. But what you have to understand, man, is really what I'm saying is be cautious and use the data, right? I'm looking, and why am I so passionate about it? I lost everything. It was unfortunate. But anyways, going back here, you guys, understanding credit's important. Matt, thank you for the comment. Here's good credit. Now, again, what did I say? Pay bills on time. Yes. That's number 1. Number 2, man, I love you guys. Thank you for learning. Number 1 most important thing, pay your bills on time. If you guys get 1 late payment, it could harm your score 80 points. Okay, right? Number 2 thing, low utilization ratio is really the most important things. Don't be late on anything, no late payments, and low utilization ratio. That's what you guys really need to understand. I want you to comment below what type of debt pertains to utilization ratio. What debt has utilization ratio? I want you to comment. Is it student loans? What is it? What is it, you guys? What is utilization ratio? What debt has utilization ratio? Please comment below, y'all. Oh, whoops. The comments aren't going down. My bad. That's right. See that? Beautiful. So proud of you guys. So proud of you. Man, I'm proud of our community here at Real Estate Mindset. Not consumer debt. No. Consumer credit card debt. Because remember, consumer debt is also like car loans. Cindy, where you at, girl? Where you at, Cindy? No. Credit cards. That's right. Thank you. Very, very good, guys. Very, very good. That's right. Credit cards are the only debt that has utilization ratio, which means if you pay your entire car loan off, it won't necessarily help your credit. Even though I disagree with that, right? It should. It doesn't. Here's the pie. All right. And really what I want to focus on is, amounts owed is right here. This is the utilization ratio. Basically, this is utilization ratio accounts for a whopping 30% of your credit score. The other thing here, payment history. So payment history is 35%. That's easy. Just don't be late. Just don't be late, right? If you're not late, you're going to be okay. So we know that in essence, 65% of our credit score can go up based on what we should do, like normal things, right? Like don't be late and don't have overextended credit card debt. That's 65%. And there's a whole bunch of little crap like length of credit, new credit cards, mix of credit, like all of those things. Like this is like really, I think it's much smaller than this. But again, the main two things and really how I got myself out of, so much debt is no more late payments and utilization ratio. And remember where I came from. Where did I come from, y'all? Southern California, so don't hate. But no, I came from bankruptcy, foreclosure, repo. I know this works, not only because of my profession, because I walked it out. So again, if you have low credit, number one thing you need to do is stop the bleeding. No more derogatory, no more late payments. Number two, you got to work your credit cards, okay? Let's go over a little bit about this, okay? Payment history. Payment history is the most important factor. Yes, I'm getting things right. It's the most important factor influencing your credit score, accounting for 35% of your total score. Your payment history includes whether you've made past credit card or loan payments on time, as well as specifics around any late payments, such as the length and time of the payment has been past due. In other words, if you guys have one late payment is going to follow you around for like 2 years. If you're late on a $20 minimum payment, just a little baby, say you got 10 credit cards, you pay them all, but just that one little credit card you forgot about, say you forgot about that little $20 credit card, that one payment, devastating. It's like unfair. It's like psycho. Never, ever be 30 days late on your credit cards, anything on your credit. It could, again, if you got like the higher your score, the farther the drop. If I have a late payment, I have a 780 credit score, my score can drop 70 points. That's not fair. That's not fair. It could drop 70 points, and that will hamper my ability to increase my score for up to 2 years. Definitely the first year, okay? So in other words, it's unfairly important to never have a late payment on anything. Do y'all understand what I'm saying here? I hope you do. All right, so let's keep going down. Amounts owed, okay? The second most, see, look at, I'm doing things right. The second most important factor of your credit score the second most important factor of your credit score, amounts owed, making up 30%, is how much debt you're carrying relative to how much you can borrow, which is also called credit utilization ratio, okay? Credit utilization ratio. So let's talk about this now, all right? Let's talk about this now. Thank you, Luke. Thank you. Now, I'm going to pull this up. I'm going to start taking questions about credit. Give me a minute. Let me answer this one first because this is a good one. I should have just started. I have a couple things I want to say to you. Here's the thing. Listen to this question. This is very, very important. Juliet's asking, what happens if you close? Let me switch over here. Sorry. Juliet's asking, what if you close an account? And specifically, what if you close a credit card account? If you close a car loan and you pay that off, it pretty much is not going to do anything. Sometimes it's a small increase. But listen, guys, if you close your credit card accounts, it generally will lower your credit score significantly. So if you think you're doing yourself a justice by cutting up credit cards, throwing them away, and closing the accounts, understand the reality of what you're doing is shooting yourself in the foot. Because now you don't have an open active account with a significant length of time. You just removed your credit history, right? Even if there's late payments, if you close that account, generally it's going to harm your credit. So in other words, okay, 99.9% of the time, don't close your credit cards. By doing so, your credit score will go down. Now, a couple things real quick. I want to teach you guys some tricks. Don't ask me questions right now. I'm going to open up the questions and then start asking your questions. A couple things I want to give you guys. This is very important. First thing is this. When it comes to mortgages, buying a house, generally there's 3 credit scores pulled from TransUnion, Equifax, and Experian. The lender uses whichever score is the middle score. The middle score is your qualifying score. So understand that. So if you have a 700 score and a 600 score and a 650 score, your 650 is going to be your qualifying score. Okay. And remember this. Utilization ratio should never be higher than 30%. Again, and I'm going to ask you guys these questions here in a minute. Utilization ratio only pertains to credit cards and should always be under 30%. Now, listen, this is important. What if you go out of town and it's an emergency and you have to use your credit card and you use your credit card and you're at like 60% utilization ratio? Listen to this. As long as you pay your credit card down before it bills, the credit bureaus will never know you extended your credit. The only thing that's reported to the bureaus is whatever's on your bill. Is that crazy? Because everyone's always like, when does it report? How does it know? When does it report? It's whatever's on your bill. So as long as you pay your bill down, as long as you pay your balance down before it bills, you're okay. Do you see how you got to work this? So in my household, we always pay it down before it bills. Right? Every time, because we use our main credit card to get points back, we get like $200 to $300 back a month just from using our credit card. But we always pay our credit card off before it bills because we eliminate all fees. But also, it's never reported to the credit bureaus. So likewise, if you think that you're doing yourself a justice by paying your entire bill off, but when it's due, you're not, because the bureaus will never see you're paying the balance down. Right? Because they're only going off of what's on the bill. So if you're waiting to the bill and then you pay your entire credit cards off, odds are you're not getting that credit score increase. Do y'all understand that? Okay. So pay it before it bills. Now, talked about one more trick. I'm going to tell you guys this trick. You guys are going to freak out. I'm telling you. Okay. So I had a lot of bad things happen to me. Bankruptcy, foreclosure, repo. Now, when I moved to Texas, credit score was still bad. It was like 550. What I had to do is I had to get a secured credit card. A secured credit card is where you put your own money down as collateral, and the lender basically gives you a credit card based on your own money. Secured credit cards are generally one of the only ways to reestablish your credit. Okay. So if you get a secure credit card, so for example, you have to put like $200 down and you get a $300 credit card. So again, the lifeline is secured credit card. Why is it secured credit card? Because credit cards have utilization ratio. All right. So if you have bad credit or low credit, you probably got to start with getting a secured credit card. You put a bit of your own money down. Now, here's the trick. In Texas, I had about a 550, I think, 550 credit score. I had 2 secured credit cards. But there's a magical trick called co-authorized accounts. This is an insane loophole. This is an absolutely insane loophole. So if you get anything from this video, understand what I'm about to tell you. Now, there is risk for the current account holder. But when I got to Texas, I had a 550 and my wife and I wanted to buy a house. I'm like, honey, I need you to put me on your credit cards so that your credit cards report on my credit profile, giving me a credit score increase. In other words, people have the ability to be put on someone else's credit card as a co-authorized user. And that trade line then reports on the person with bad credit. It reports on their credit report. So I went to my wife, and my wife had she still does. I have better credit now. I can't believe that. But my wife had phenomenal credit, and she had like 5 credit cards. And on the credit cards she had, they were in perfect condition. You don't want to be co-authorized on a credit card that was ever late or overextended. But my wife was never late, and her utilization ratio was like 0. So she called up the credit card company and was like, hey, can you put Travis on my credit cards, right? I'm not joking. 45 days later, she put me on 3 of her cards, okay, in good standing. 45 days later, my credit score went up 100 points, and we closed on a house. Okay. The disadvantage of co-authorization is as a co-authorized user of her credit cards, I can then do stuff on the account. I can close the account. I can ask for an additional credit line. So most people aren't going to do co-authorization unless they're your family or your spouse. And if you have a spouse, listen, you guys, if you have a spouse or significant other and they have good credit and you have bad credit, if they call and co-authorize you on their only on their credit cards in good standing, that's a trick to give you guys a massive credit score increase. So, and you guys, hope you enjoyed. That's what I wanted to give you today. We are on for about an hour and 8 minutes. That's about it, you guys. I hope you guys got, I really hope you guys got some value. I'll take some questions if you want to shoot some questions up. Okay. Here's a good question right here. What about opening up a new account? You guys, if your score is like low 600s. What I have found is the optimal amount of credit cards that, again, I have found is 3 to 5. Like when you first establish, you're probably going to want to get 3 credit cards, because remember, each time you get a credit card, that inquiry or people like looking at your credit, it's called an inquiry, is going to harm your credit. So there's no grace period with credit cards. So you don't want to apply for a whole bunch of credit cards. If you have low credit, don't apply for the top credit card. You need to apply for secured credit cards, because if you start going for the top credit cards with low credit, all you're going to do is hurt your credit even more. So if you have bad credit, open accounts that are like for bad credit, or you're going to doom yourself. Okay, I hope that made sense. Oh my gosh. Okay. What if you only have a single credit card? Does that look bad when it depends, because they're going to look at more than just your score. They look at like your history with car loans and the size of debt. But again, going back to generally, you want at least 3 credit cards. And on my credit profile, I found that 5 credit cards are optimal. And I understand what I'm saying. Yes, I have 5 credit cards, but I'm not using any of them. I'm only using one that gives me points. The other 4 I use once a month so they don't deactivate. If you don't have any history on your credit card spending for 6 months, it's that trade line is deactivated from your credit profile. So you have to use it like one time every 6 months. It depends what your score is. Do you open a new credit card account if you're planning on buying within 6 months? If your score is low, I may do that. But remember, I would say 6 months, yeah. But remember, that first inquiry is going to hurt you. It's really hard for me to say that without looking at your credit profile. Yeah, exactly, Jeff, because you probably have good credit and don't spend. You know what I mean? They give those offers, to increase limits to people that are not exposed in debt. Okay, let's see here. Okay, so we got a disagreement. Curtis disagrees. We pay our credit cards off each month, $840. The credit cards are the only revolving debt that we have, as we are debt free. So this is Curtis. The thing is you don't have to agree or disagree with me. This is how it works. All right. And what you're seeing here is longevity. Have you ever been late, Curtis? No, you haven't. Okay. Are your credit cards overextended and with low utilization ratio? They are. All right. Well, how did I know that? Because that's what you just said. Again, this is not about agreement or disagreement. The fact is that what is on your bill is what's reported to the bureaus. That's a fact. So you could disagree with it if you want, that's fine, but it's still a fact. And my point is, Curtis, is mainly for people that don't have an 840 credit score. Obviously, you're doing something right. My point is if anyone's under the process of like increasing their credit, understand how the information is reported on the bureaus. That's my point. So understand how the information is reported on the bureaus. Appreciate that, Curtis. Okay, let's see here. Boom, 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 boom. Prices. I'll bet you they won't, Jeff. You know what? I want Jeff to apologize. I can't wait till he apologizes to me for all of the punching bag I've been for this man, because I love him, Jeff. And he's been a punching bag for me too, but I'm more the punching bag than you, Jeff. But I do lean on him. But I bet you you're wrong, Jeff. And I know you want to be wrong too, right? I'm going to say that I will bet you. I'll bet you $1, gentleman's bet. Tell me if you agree. Tell me if you agree. At $1, gentleman's bet. How long does adding an authorized user affect the cardholder's credit? Forever. Johnny, the thing is like, as long as that person's co-authorized on the original creditor credit card, if that authorized user is like late or anything like that, it's going to devastate the credit of the other person. But the thing is you're being put as an authorized user not to use the credit card. Don't give them a credit card. You're only being authorized on the account to increase your credit score. So if someone asks me like, hey, will you co-authorize me on your credit card? I'm like, no. Why would I? I'm not going to risk myself. But if it was like my family, my children, and my wife, I'd be like, okay, yeah, sure, I'll do that. But you ain't getting the credit card. And if I find out you call them or spend it, I'm taking it all away from you. But yeah, there is risk for sure. On the credit freezes, it's hard for me. It's good when you want to like fight fraud and stuff like that. But like for me as a loan officer, it always frustrated me because I had to call clients that had credit freezes because I couldn't pull their credit, and they had to call and remove the freeze. But it's a safeguard. But just remember, if you have people pulling your credit, you have to remove the freeze. Okay, I have $45,000 in student loan. As of now, I have almost 30K saved up in cash and gold. Should I clear all money out to pay that off? So the thing is, it depends on your situation. My immediate thought is no, you should not pay that off, because generally student debt has a super duper low interest rate, and they also set up payment plans. So even though it's it's not a good debt. Any debt's hard. At least it's not credit card debt. You know what I'm talking? Like if you have $48,000 in credit card debt, I would say yeah, probably. But and then it also depends what you're doing with that $30,000. Like if you can't do anything with that $30,000, fine. But if you can invest that $30,000 and make money, like on a treasury bill or a high yielding savings account, you're probably going to want to do that because it's yielding 4 to 5%. I'm assuming your student loans are probably 1 to 2%. So you would make more money investing. You see what I'm saying? And that's why. And also, student loan debts don't have a high payment when calculating against debt to income ratio like credit cards. Okay. Thank you, Jackie. Appreciate that. Jeff, he's like on the other extreme. That's why I love him so much. He just his ideas I don't think of sometimes, and he forces me to think about things. Thank you, Jeff. Appreciate you. Let's see here. Oh, okay. We got some more questions. How does purchasing a fixer home with a mortgage, rehabbing the home, then refinancing to pull out equity affect your credit? So here's the thing, Johnny. Every credit profile is different, so it will affect different credit profiles differently. But generally, getting a mortgage and then refinancing into another mortgage, it probably only hurt your credit as much as the inquiry. Because remember, it's not mortgages don't have utilization ratio. So it doesn't matter how much you've paid that debt down, it's still not going to show utilization ratio. So Johnny, the thing is, it will affect your debt to income ratio, your purchasing power. As far as debt to income ratio, it really won't affect your credit outside of the initial inquiries done to run your credit to see if you're approved. I hope that made sense. Question: we have excellent credit, one credit card, haven't had car loans in years. Should we open up? I would, Cindy. I find that, again, the minimum people want is 3 credit cards. My credit profile, again, from doing so much research on what if analytics on my own personal credit profile. But I think you should get a minimum of 3. But listen to me very, very carefully. I don't think you should use them. You should get 3 only to build your credit. You should not use them, but you have to have a little bit of activity. So once every 6 months, buy a stick of gum, right? Don't go out and eat. Don't go out and get your gas. Just very tiny charge. And same thing if you get a secured card. So the same thing if you get a secured card. Okay, good one, guys. Oh. When your credit card expires and a new one is issued, does it negatively affect your credit? I heard that it counts as an inquiry. It depends, Johnny, if a new credit card account number is issued. If a new credit card account number and trade line is issued, it can harm your credit because they just closed the trade line that you had possibly for the last 5 years. So they just doomed you, right? So depending on if they issue a totally new credit card and trade line, yeah, that can hurt your credit. That can absolutely. Anytime you close a credit card, it can. It doesn't. It may affect your credit a few points, 5 basis points, or I'm sorry, 5 points, maybe 10 points. But overall, and this is crazy to me, that overall paying off your car, it really doesn't help your credit score that much. It's really mind blowing to me. Again, you guys, that's pretty shocking because it should, right? It's a huge debt. I forgot to put a timestamp on the questions. Okay. So good questions, you guys. I'm just really, really so proud of the community that we built here. Are the new builder incentives make it worth to purchase a house? My brother, watch the beginning of this video and answer that question, okay? It depends. It depends because some of the best houses that we found had price increases. Some of the best deals had price increases and the worst deals had decreases. It's a game, brother. You need to analyze the data to really answer that question. And in my other video where I'm going to go into the massive lies home builders are telling, I'm going to show you guys the Highland, and then I'm going to show you guys a distressed community of new building, a distressed community of new building where the price cuts are actually, ouch, under market value. Tricky with these people. Let's keep going. I think so. I think so. I think so. I mean, I told you guys why do I think that? I mean, they're well, a couple reasons. They're drastically overexposed. I mean, they're not phasing properly from what I saw, especially in Phoenix. I've never seen anything in my life when I went to Phoenix, in Copper Canyon and Desert Oasis. There's thousands of houses without buyers. And doing more research on that, I think that they were banking on the chip plant happening in Phoenix. That's not looking really good for them. Really brutal. Really, really brutal. Okay. Good one, Ryan. This is a good one. So Ryan's check, so if you have Credit Karma, as an example, like if you use Credit Karma, it's going to have a different credit score than if you go shop for a home loan. The reason that is, Ryan, is every industry has a different way of calculating your credit or algorithm. So like Credit Karma has their own algorithm, and their credit score is generally higher than if you run your credit for a home loan. The algorithm for a home loan is different. So you see what I'm saying? Just like when you run your credit shopping for a car, that industry looks at different parameters when giving you a score. So different algorithm, brother, different algorithm. What's up, Ray Neil? I have an 800 credit score, which is a blessing and a curse. Blessing because I qualify for anything I want. Curse because I qualify for anything I want. That's funny. All right, let's see here, you guys. I think that is... Oh man, I'm way, I think, okay, what's your take on Phoenix third quarter? Credit is in order, but the prices of homes here, sir. Now, Nicole, you remember, I really want you to do the research yourself, but I'm on a talk. I'll answer this more because I went to Phoenix. So because I went there, boots on the ground, I think third quarter is absolutely, I think it's going to show you some beautiful things in the third quarter. I think it's already going to, if you can get with a realtor that can help show you what I just showed you in the Phoenix area, especially Desert Oasis, Copper Canyon, you're going to see some wild things. The problem is, Nicole, you got to get past the reckless cheerleading just to even get the data. So you got to get through maybe 10 realtors before you find anyone to help you. But I definitely think that of all of the metro areas, I think Phoenix is going to get smashed hard, especially if that chip plant doesn't come to fruition, which it's not the way that they wanted it to. Look up the chip plant in Phoenix, y'all. Pretty wild. I believe so. I think so. Co-authorized user. Yeah, I'm pretty sure it is. I'm pretty sure it's the same thing. Okay, pay later. Johnny. Question. Do you know if these pay later program like Affirm hurt your credit? I see a lot of them that say it will not run a full credit report, but just a soft inquiry. Is that true? Here's the thing, man. I think Affirm is bad because if you can't afford something, don't buy it. To me, Affirm is just making society even worse spenders. I hate it. If you don't have it, don't buy it. I hate it because I already lost everything because I used to have that lifestyle, right? If it's an inquiry, it's going to hurt your credit. If it's a soft inquiry, maybe not. There's certain algorithms that pull a soft inquiry that doesn't hurt your credit. So it is possible, Johnny, but I don't think people should be doing Affirm to begin with. We're probably in recession right now, Okay, let's keep going. Okay, this is good. Okay, good. Okay, we got a warning on secured cards. This is good. Let's see what it says. Warning on secured cards. A $500 credit utilization is more extreme if you get caught after statement date with 51 instead of 47 can drop your score a lot. That's correct. Now that's over exaggerating just a tad, but because it's 10%, that utilization ratio of 51 and 500 is a little over 10%. But he brings up really good point. And really what he's trying to say is there are tiers of improvement for utilization ratio. The least effective tier is under 30%. So that's why I say you don't want to go over 30%, but understand that's the least credit score increase tier. The optimal, I think, is 7%. So in other words, if you want to increase your credit score, just don't play the game. Just don't play the utilization game. Just don't use your credit card, right? Except once a month and buy a banana. 60 cents. That's it. If you are trying to reestablish your credit, you get a secure card and you immediately start getting gas or going out to eat or to the dinner, all you're doing is hurting yourself even more, and it's going to take you even longer to get out of your situation. If you're going to get a secured card, you must use it properly or more harm will happen. I see that all the time. I would say I've put probably 2,000, 3,000 people for mortgage in my residential mortgage job in what I call action plans. And every step of the action plan is obviously stay encouraged. And then the second thing is, get a secured card. But, and I'm really like, I look at them in the eyes. I'm like, you do not use a secured card when you get it. Still 70% of the people used it and maxed it out and they were in a worse situation, literally still. So it's like the human psychology is just messed up, man. That's crazy. I have no idea why they would reduce your limit. Were you late on the account ever? I'm not sure. Okay, let's see here. Johnny's got some really good. Johnny's a really smart person. Actually, I've talked to Johnny on the phone. He's not just a troll, you guys. That's why I love. He's a sophisticated troll. That's why I always love Johnny. He's a sophisticated troll. Question: do you enjoy? Oh my gosh, Johnny. John, you sent me. You know, when I see some names, I just throw the comment up. I didn't even read that. He's trolling me, man. And then Jeff is trolling me. Anyways, I like the video you had the other day that showed huge price cuts in Montgomery area. The one in Cleveland. Did you see that, Scrog? The one in Cleveland. So again, my deal to you guys is now my boots on the ground data. I'm going to start the video by showing you average price per square foot so that when I go into the boots on the ground data, we actually know if it's a great deal. That was my bad. I haven't been doing that. I'm going to start doing that. Okay. Okay. Here's a question by Rick. This is good. I have not talked to you guys about disputes. Disputes is huge. I had a dispute okay, wait, I'm so sorry. I had a dispute on 4 collections. I had dispute comments removed. This is important. And it dropped FICO 2 score 30 points. This is important. I'm trying to settle balances and request trade line deletions. Can I recoup the points? Yes. This is such a good topic right now. Let's talk about what is it called when like credit repair companies. You guys, I used to own a credit repair company back in 2002. I was like a master. I still am a master on credit. I know everything about credit because I lost my credit and I got it back. So I had to go through all the motions, and I was very intrigued by credit scores. Credit restoration companies are generally a ripoff. They're generally a waste of time. You can usually do things like 99% of the time, actually 100% of the time, you can do them better than a credit repair company. Generally, when when you pay a credit repair company, all they're doing, first of all, is disputing the accounts. That's it. They're disputing your accounts and your score shoots up. So people are like, oh my God, it's working. It's working. My score went up 50 points. But the reality of what they just did is, when you dispute your account, you remove a lot of the negative impact on your credit score. So if you disputed account, if you have an account that's disputed because of a late payment and you put a dispute on that, generally your credit score goes up, who knows, 30, 40 points, okay? But here's the thing, when it comes to mortgage, the underwriters know this game. So in residential mortgage lending, it is a requirement. So like when I'm a loan officer and I review credit, I always look at disputes, because in order to get a loan, you can't have disputed accounts. Why can't you have disputed accounts? Because most people, that's actually derogatory and they're trying to cheat the system and get it removed. So it's like a little Band-Aid they put on a bullet hole. So we as lenders and loan officers have to remove all the disputes. And I've seen credit scores drop 100 points. You can't just dispute. Now, trade line deletions and things like that, those are all things you could do yourself. If you have like a year and a half or 2 years per se before buying a house, it may be a good idea for you to dispute accounts. Now, here's what I did. When I was going through the process of bad credit to home ownership, because remember, I lost everything. So I went bad credit and then my first house. What I did is instead of disputing, because I knew that's a joke and I couldn't use that, and this is my collections, and I had to do this for my license as well. So I had 4 collections on my credit. And what I knew when it came to collections is that I could settle the debt for less than what I owed. And I also knew a little trick that is almost as powerful as authorized user accounts. I called my 4 collection companies up and I said, listen, I'm willing to settle. This ain't my debt. I'm playing the game too. Let me play the game too. This ain't my debt. I don't know whose debt this is. This ain't my debt, but I'm willing to settle with you. And unfortunately, I'm in a rush. So I'm either going to settle with you, and you have to give me something called a deletion letter. The deletion letter is what they send the credit bureau files. And basically I said, you got to give me a deletion letter that says that this account was reported to the bureaus by mistake. You guys, these collection companies are so greedy, they just want to make money. So I was able, this is insane, I was able to remove 2 of my 4 collections completely from my credit profile. That gave me like a 30, 40 point increase in my score. They just removed it. So again, my deal with them is I will settle my debt, but you need to issue me a letter of deletion saying it was reported in error because it's not my account. Can you prove it's my account? Right? And again, 2 of the 4 people, the other 2 people settled with me for 50 cents on the dollar. So when it comes to paying off collections, in my opinion, obviously if you have to avoid a lawsuit, it's different. But if it's just normal collections, there's generally no reason to pay that off unless it's like lending restrictions or licensing, because paying off collections doesn't help your credit score. Paying your collections can sometimes hurt your credit score. Paying collections don't help your credit score. Listen, they've already hurt you. It almost makes no sense unless you get something called a deletion letter. Now, I had to remove the collections from my credit report because it was a licensing requirement. But the only thing that's going to help you is a deletion letter from those collection companies. I'm sorry, you guys. There was a little bit long of a ramble. Really important. Let's see here. I'm going to get some more questions. Okay, so this person's asking, how do you qualify for more? Okay, so now FICO score does have a play in the amount you can qualify for if you have low credit. But as long as you have like basically like 680 to plus credit score, you're generally going to qualify. Like the down payment is generally going to be the same. What matters as far as down payment is your debt to income ratio. Your debt to income ratio is basically showing the lender how much you could afford of your income to go towards the house payment. So if they're saying you have to put 20% down, but you only want to put 10% down, you have to, and this is just, there's so much details I don't know, but you have to determine how to get your debt to income ratio down. Generally, ways to get your debt to income ratio down is by paying off your credit cards or any debt that you have a monthly payment, because your monthly debt payments goes against your debt to income ratio. You see what I'm saying? So Tony, it's not really about credit per se. It's more about debt. So get rid of your debt, qualify for more. Question, when do you think will be the next refinance purchase boom? Past 2025. Now that we, less dust in the air, we have more info. It just depends how many black swans. I mean, y'all, we got a lot going on here. We got the dollar, being destroyed. We got BRICS. We got the Fed Now system coming out. I could see the housing market crashing for like 5, 6, 7 years, to be honest with you. I don't know. But if I were to guess 2026, 2027, maybe 2028, I don't know, because I don't know what's going to break yet. And then how bad it's going to break and how much everyday life is going to change. Okay. Let's see here. Scrolling down. Scrolling down here. I'm just looking for questions. Oh, so, okay. So the reason why he was asking about a firm, so he's trying to be smart is, yeah, that's a little bit different, but Johnny, there's probably fees. So I don't think it's going to hurt your credit. I really, if it's a soft pull, it shouldn't hurt your credit, even though, it's ridiculous, but it shouldn't hurt your credit. And I see what you're saying. If it's 0% for 18 months, you could take that money for 18 months, buy some treasury bills and make money on that money. So I get it. But Johnny's really smart and savvy, you guys. I'm talking generally here. If you're super smart and savvy, we can always talk about like, super custom and specific ways to do things. And Johnny's really good at that. So the account will immediately, so if you are getting a credit card, say you have a weak credit profile, I'm not talking about a well-established, I'm talking about one that's not that established. The second the secured credit card reports on your credit and you didn't charge it, you're listening to me, you're not using it, you should generally get a nice credit score increase of 20 to 30 points. Now, after that, you're going to get slow credit increases per trade line, per account, every month, as long as you're using it the right way. So every month you may get another 5 points or another 6 points or another 5 points, but you usually, Juliet, get an initial credit score increase the second that the secured or any account reports on your credit, as long as it's a credit card. See? Look at, he gets it. He wasted hundreds of dollars in credit repair. All they're doing is they're putting disputes on your credit, and that's it. And your credit score goes up, and everyone thinks they did a good job. And if you go to apply for a loan, the loan officer has to remove it. And by removing disputes, generally the lender has to charge the consumer. It just depends on the state and the law. But so imagine that. Like, I've had to charge people hundreds of dollars and reverse the credit repair company's effort that they did, because you can't use, the disputes aren't real, right? It's crazy. We watch for the, thank you, Jane. If they're trolling you, you are doing something right. We watch this for us. Honestly, Jane, I appreciate that. I appreciate all y'all's love. I'm a normal person too. I'm conceited. I'm insecure. I try not to show it. I'm just kidding. I pray. I mean, I try to be a really good person, y'all. It's Jane. The problem is I get that they troll me, and Jane, I gotta be honest with you, and I gotta do a really better job of this, because I know I'm a really good person, but like the way I was raised, it was a little bit old school. It's like when someone pushes me, I push back, and I guess when I'm a man or whatever, so I control these people so hard, y'all. I control them so hard because I know all of the things that they're doing that is basically a scam. So I can get them hard. My issue is not really what they're trolling me, it's they're trolling other people. They're playing this narrative that we're stupid, even though it's crashing in many metro areas, even though we see systematic failure. They're saying that we're stupid because we're not telling people to buy. So my issue is like, what if someone is like struggling on the sideline that reads that comment and then decides to YOLO? Are they helping the situation, or are they hurting the situation? Sorry. Okay, y'all. Medical collections you normally don't ever want to pay. It just depends. As long as you have, I have to read the new underwriting guidelines, but as long as you generally have a cumulative total of less than $2,000 in collections, it doesn't even affect your loan. And generally, medical collections are never used to affect your loan. But sometimes if you have a cumulative total of over $2,000 in collections, FHA requires a payment to be calculated on that collection amount. I believe it's 2% to be used against your debt to income ratio. In other words, don't have collections. That was a little complicated. Okay. All right, here's a good one, Johnny. If you don't meet the debt to income ratio requirements but have enough cash to buy the house in full, do the mortgage agencies take into account liquid cash or assets? No, because if you're going to pay cash in full, you don't need a mortgage, right? And that's why everyone loves cash buyers, because they don't have to go through the unpleasant mortgage process. It just, the lower down, the higher DTI. But VA, although DTI is used for automated underwriting for VA, VA does something that I really think that all loans should do, which is residual income calculations. So VA takes like net income, not gross income. So VA takes net income, and then they minus like real expenses like utilities, taxes, and insurance. And as long as you have like this much money left over, you can afford the house. So it's not a percentage of your income. It's like, how much money do you have left over after you've spent all your money based on the size of your household. So I think VA loans are one of the best loans. And if you have any disability, the VA funding fee is waived. And the VA funding fee is, I think it's 3.15% of the total loan amount. So it is high, but it's a great loan. No mortgage insurance on a super low rate. And if you're in Texas, VA, Texas Land Board, take a look at that. Okay. So anytime you use a gift, it can hurt your strength of approval. But the question is will it hurt the strength of your approval enough to not qualify you? Sometimes yes, sometimes no. If you have decent credit and you have other good things going for you, a gift shouldn't hurt you. But if you have like low credit, you have no money, you're overextended on everything, sometimes you can get disqualified if it's not your own money and you're using a gift. Now, let me explain this. Sourcing of money for lending guidelines. Okay, it's really important that you don't use cash in real estate. It's a huge no-no. If you use any cash in real estate, it's a major problem. So you have to understand what the lenders are looking for when it comes to verifying assets. In order for the lenders to verify assets, they generally review the last 2 months of the bank statement where the money's coming from. So where the money's coming from, they verify 2 months of bank statements, and when they look for is deposits. Isn't that crazy? That's how they verify. So if you have any cash deposits in the last 2 months, you can't use it for the transaction. If you have any deposits in the last 2 months that they won't approve, they remove that out of your approved cash down payment. So in other words, if you're going to get a gift, you probably should do that 3 months before you move in. If you do that and the lender asks for 2 months of bank statements, will they even ask you about the gift? Anyways, see what I'm saying? And they look at the last month of the gifter's statement. So if my parents gave me a down payment, man, I'm going to take it. I'm going to take it. What's up, Danny? I'm going to take the down payment. Exactly. I mean, Seattle is just really crazy. Okay, here's a question about collections. And I'm gonna get going here, you guys. It's almost 2 hours. Question: what if a medical collection is reported for less than $500 to the bureaus prior to closing on a house with the FHA loan? What should I do? Nothing. You should do nothing. If you're in the process of like buying a house right now, my man, you need to ask your. It's so hard because some loan officers are garbage, but some are really good. You need to ask your loan officer what you should do. Not me. They're the ones that are giving you money. I'm not, right? So ask them what you should do. And more than likely, if that collection comes up in the middle of the transaction and they do a credit refresh, it could doom you, man. You should be okay. I don't know. That's a hard one. I'm because I'm a loan officer, I think you should tell your loan officer everything. Unfortunately, some of the things that you say may disqualify you, but you want to find out right now versus 2 days before you're closing. Okay. I hope that answered that. Oh, Deuster. Really like appreciate you guys. Yeah, he gets it. Oh man, appreciate you. You guys know I'm not a financial advisor. I'm just talking about myself right now. I'm not advising anyone personally. I'm just answering stuff for myself right now. But man, I appreciate you. You guys don't have to give me super chats. You guys don't have to do that. I want you to say, but I do appreciate it, man. I know I'm going to take a hit in the recession. I'm going to take a hit. I know I'm going to lose my job. I know that. I have to. There's no business. I have to lose my job. So I'm freaking out a little bit. But brother, thank you. I really wanted to do stuff like this today because this is the real valuable stuff. This is the behind the scenes stuff. This is like my skills and my experience. And I just want to pour that out to you guys because I'm sick and tired of this toxic cheerleading and this emotion. And I feel for my friends that are emotional, but I'm also tired of it because I'm emotional too. I can barely handle my own emotions. Can you tell? Jeff, Johnny, Vital, it's your turn. I need y'all to handle my emotions now. I need your help, you guys. I'm getting beat up here, man. Appreciate you guys very much. Let me look at Johnny. Okay, follow up. Well, I don't want to buy a house all cash. I want to keep my cash on the side. Good man, good man. And why I'm thinking about a mortgage, it would be painful to, yeah, it would be. Johnny, I don't believe in buying all cash for houses right now, especially right now. I think we save our liquidity and we continue to invest with it. You become a millionaire during a recession as long as you could take the hit, right, guys? We need to take the hit. We're all going to take the hit, in my opinion. We're going to take the hit. We got to get through that part. When we get through taking the hit, we still got to be well qualified. Think about it. Okay, y'all, I'm going to think this is it. Yes, this is it. I'll do another video about Opendoor. I'm exhausted right now, y'all. I'm exhausted right now. That was a lot. Appreciate y'all. I think that's going to do it, you guys. Again, reference this video, watch this video again. I'm telling you guys, if you just get 15% of what I talked about today, you're going to be above 99% of the buyers out there. The stuff that we covered in this video, that's from my soul. That's 21 years, you guys. That's how it works. That's the data. Listen to the data, watch the data, stay away from the emotions. Okay. Now, again, if you're on the sidelines, credit, income, assets, empowerment, mindset, love your family, spend time with your children, spend time with your wife, hold the door open for someone. Buy the person behind you coffee at Starbucks, which I usually don't go to Starbucks anymore because, oh my gosh, what's with all the political stuff? But just love some people. That's going to help you guys, right? Anytime I'm down, you guys, when I start loving people, it just makes me feel better. And we get to help and love people. So anyways, I really appreciate you guys. I'm going to get out. Oh, wait. Okay, take a look. Okay. This is it. We're going to end here. Now the question is, I saw that comment, Johnny. Dang, Johnny can troll me so hard. I gotta stop looking at your stuff, Johnny. You get me. Because I wear my heart on my shoulder, I can't act. I think that's why, I don't know. Maybe that's why the channel's doing good. I can't act. I don't know how to act. I can't even fake smile. I have to be myself. That's why I'm saying I hope you guys appreciate me when I become a realtor, because I'm passing so much business right now because I don't believe in it. I don't believe in it. And I'm walking this out with you. I'm renting. I hope you guys appreciate that. Man, I'm missing out so much money. Pretty much paid off my credit card. Do I leave it zero or leave a balance? You're going to want to leave a zero balance on your credit cards, except for once every 6 months, my man. So once every 6 months, buy a banana, buy a stick of gum. My point is buy something like really small. The problem that people make is, especially with secure credit cards, is they go out to dinner, they go out to eat, or the movies or something, and they jack it up way too much because secured lines of credit have a really low balance. So good job. Keep it paid off, leave it zero unless it gets that 6 month. And this is just for my own. I'm not giving him financial advice. I'm just saying this is what I would do in that situation. Whoops. But yeah, it's not financial advice. Oh. This is it. Can you do an appraisal course? I have 4 courses. Can you do an appraisal course for all of us in other states that is not certified? I would so pay for that. So would 95% of my office. I love it. I actually, I have like I said, a couple of them are expired. I'm really only teaching one class, but I made over the course of the last 3.5 years, 4 Texas certified classes on how appraisals work. The reason I did that is during the COVID lockdowns, there was no comps. So the appraisals, if you guys remember, the appraisals were coming in $30,000, $40,000, $50,000 low. And I had a rebuttal because as the lender, we're the clients of the appraisal. I had a rebuttal like 19 appraisals. Of the 19 appraisals, I successfully reversed 17. Yeah. 17 of the 19. So I got so fed up. I'm like, you know what? Enough of this. I'm doing the appraisal's job. Like, this is making me so upset. Like, why am I the one that have to do this? So I put a class together and I started empowering all the realtors that I could in Houston so they wouldn't have that same problem. The problem with some appraisals is if they go to like subdivisions that they know nothing about, they can get the appraisal totally wrong. And that's what we see a lot of. Am I going to pay for me? I would consider it. You know, maybe I'll make a poll. Should I pay for a plane ticket for Johnny and for Jeff to come with me to Boise? But the thing is, Johnny, I'm not just going to Boise. I'm going to drive to Utah from Boise. So if you want, you have to drive. I actually had someone, viewer that said they're in Boise, and there was a realtor as well. I'm going to reach out to them because I need to get the average price per square foot. But someone said that they have a rental car for me to use. I was like, what? Why would you show me that much love? That's awesome. But yeah, Johnny, I would consider that. Anyways. All right. I think that's it. Okay. That's it, you guys. I'm going to get out of here. Happy Thursday, right? It's Thursday. I did not go to Austin. The weather was bad. But I definitely appreciate y'all. Make it a great day, you guys. And obviously, get off your life. It's been 2 hours. Yeah, right. Renee's right. I don't want to leave you guys. I want to stay here. I want to keep helping. But regardless, you guys, if you're out there investing in real estate, you already know. I wish you luck, and I hope you